After studying this module, we shall be able to elaborate the relevance of the capital structure in determining the value of firm. We shall also be able to understand the meaning and working of net income approach and how the value of the firm is maximized by employing different capital structure or debt equity mix on the basis of this approach.
Capital structure is the debt equity mix in the total capital of the company to finance firm's assets. Debt and equity differ in cost and risk perspective. From the viewpoint of company raising funds, debt is considered to be a cheaper source than equity share capital. However, debt also increases the financial risk of the company as against equity shares. As we know that the financial leverage, that is, use of debt financing, affects shareholders' earnings and risk, earnings per share, that is EPS, increases with financial leverage only under favorable economic conditions. But use of both debt increases the risk of shareholders also. Therefore, it cannot be stated with surety or conviction whether use of leverage or debt will increase the firm's value or not. The capital structure decision should be examined from the viewpoint of its impact on the firm's value. If the capital structure can alter the value of firm, then it would like to have a capital structure which maximizes firm's value. Such a capital structure is termed as optimum capital structure. Number 3. Capital structure and firm value is being discussed now. There are two schools of thoughts relating to this concept. There exists two schools of thought on the relationship between capital structure and value of firm. One view is on relevance of capital structure, that is, capital structure affects the firm's value. The capital structure theories which support this view are net income approach and traditional approach. The other school of thought, led by Modigliani and Miller, argue for the irrelevance of capital structure. That is, capital structure is irrelevant in determining value of firm. A firm's value is independent of its capital structure. Theories which support this viewpoint include net operating income approach, hypothesis, and Miller's argument. We will discuss them now one by one. 4. Net income approach. Relevance of capital structure. The net income approach was developed by David Duran in the year 1959. As per the net income approach, there is a relationship between capital structure and value of the firm by increasing or decreasing the debt proportion in overall financing mix. This approach shows that capital structure has relevance in determining the value of firm. Therefore, the value of a levered firm, that is, a firm which uses debt capital, will always be higher than the value of unlevered firm, that is, an equity firm, that is, an all equity firm. Further, the higher the amount of debt capital in the capital structure, the greater will be the firm's value. The net income approach makes the following main assumptions. First assumption is the total capital requirement of the firm is given and remains constant. The second assumption is the cost of debt represented as KD is less than the cost of equity represented as KE. The third assumption is both KD and KE remain constant. An increase in financial leverage, that is, use of more and more debt financing in the capital structure, does not affect the risk perception of the investors. The fourth assumption is there are no taxes and no transaction costs. And fifth and the last assumption is that the firm has perpetual life. Given these assumptions, it can be observed that the proportion of debt capital increases in the total capital of a firm. Its overall cost of capital declines continuously. This happens because cost of debt is lower than the cost of equity capital, and irrespective of the degree of financial leverage, these two costs remain constant. Hence, as the proportion of debt capital rises, cheaper debt replaces expensive equity capital and the overall cost of capital declines, resulting in increase in firm's value. In figure 1, one can observe that as more and more of the debt capital is used, the overall cost of capital declines because cheaper debt replaces expensive equity capital. Decline in overall cost implies that the market value of the firm increases with increase in the amount of debt capital. We will use the following notations in subsequent equations. Value of the firm is VF. Value of equity is E. Value of debt is represented as D. Interest amount is shown as I. Earnings before interest and taxes or net operating income is represented as NOI or EBIT. 5. Firm valuation. Using net income approach, we can calculate the value of a levered and unlevered firm as discussed below. Value of a levered firm. In case of an unlevered firm, there is no use of debt capital. Hence, it is an all equity firm. In such a firm, the overall cost of capital, KO, comprises of only cost of equity, that is KE. The two are equal. Further, there is no interest to be paid by the firm. Therefore, the entire net operating income or EBIT is available for distribution as dividends to shareholders. In such a case, the value of firm will be capitalized value or discounted value of all the operating earnings of the firm, with KE as capitalization rate or appropriate discount rate. Hence, VU is equal to EBIT divided by KE. Let us now understand value of a levered firm. A levered firm is that firm which uses both debt capital and equity capital in capital structure. Mathematically, a firm's value is calculated by adding value of equity and value of debt. Value of a levered firm is equal to value of equity plus value of debt. VL is equal to E plus D. Value of equity is equal to discounted value of net income available to equity shareholders. E is equal to net income available to equity shareholders divided by cost of equity equal to EBIT minus 1 divided by KE. Value of debt is equal to discounted value of interest. D is equal to interest divided by cost of debt equal to I divided by KD. Hence, VL is equal to NOI minus 1 divided by KE plus 1 divided by KD. Further, we can calculate the weighted average cost of capital represented as WACC denoted by KO as below. KO is also termed as overall cost of capital. KO is equal to WE multiplied by KE plus WD multiplied by KD, where WE is proportion of equity capital, WD is proportion of debt capital. When we are given the net operating income NOI or EBIT relating to a firm and its market value is V, then the following identity holds true. KO is equal to net operating income or EBIT divided by V. As per NI approach, the optimum capital structure, that is the one having minimum overall cost of capital, is one when 100% debt financing is used. This will maximize the value of firm. However, NI approach is criticized due to its unrealistic assumptions. In real life, we cannot have constant cost of capital and debt. Further, presence of taxes and transaction costs also distort the relationship between capital structure and firm's value. As per net income approach, a firm can increase its value and to decrease its WACC by increasing the debt proportion in the capital structure. Therefore, there is a direct relationship between value of debt and value of firm and negative relationship between value of debt and its overall cost of capital, that is WACC.
First of all, we'll discuss the meaning of capital structure. Capital structure is the debt equity mix in the total capital of the company. We know that debt and equity differ in cost and risk. As debt involves less cost, but it is very risky security because of regular interest payment, whereas equity are expensive securities, but these are safe securities for company's point of view, as company has no legal obligation to pay dividend to equity shareholders if it is running in losses. In theory, there exist two views on the relationship between capital structure and value of the firm. One view is on relevance of the capital structure. That is, capital structure affects the firm's value. The capital structure theories which support this view are net income approach and traditional approach. The other school of thought, led by Modgilani and Miller, argue for the irrelevance of the capital structure. That is, capital structure is irrelevant in determining the value of the firm. A firm's value is independent of its capital structure. Theories which support this view include net operating income approach, hypothesis, and Miller's argument. In this module, we will learn about net income approach of capital structure. We shall discuss net income approach. As per net income approach, there is a relationship between capital structure and the value of the firm, and therefore firm can affect its value by increasing or decreasing the debt proportion in overall financing mix. This approach is based on certain assumptions such as the total capital requirement of the firm is given and remains constant. Cost of debt is less than the cost of equity and both the cost remains constant. As per this approach, the overall capital declines and value of the firm increases with the increase in leverage. Let us discuss this approach with the help of a diagram. The cost of equity and cost of debt remains constant at any level of debt capital. We can observe that as more and more of the debt capital is employed, the overall cost of capital declines because cheaper debt replaces expensive equity capital. Decline in overall cost capital implies that the market value of the firm increases with the increase in amount of debt capital. As per net income approach, the optimum capital structure, that is, the one having minimum overall cost of capital, is one when 100% debt financing is used. This will maximize the value of the firm. However, net income approach is criticized due to its unrealistic assumptions. In real life, we cannot have constant cost of equity and debt. Further, presence of taxes and transaction costs also distort the relationship between capital structure and the firm's value. Now, let us understand how to calculate the value of the firm. In case of unlevered firm, there is no use of the debt capital. Hence, it is an all-equity firm. In such a firm, the overall cost of capital KO comprises of only cost of equity KE. That is, the two are equal. Further, there is no interest to be paid by the firm. Therefore, the entire net operating income or EBIT is available for equity shareholders. In such a case, the value of the firm will be capitalized value or discounted value of all operating earnings of the firm, with KE as the capitalization rate or appropriate discount rate. A levered firm is one which uses debt capital in its capital structure. Mathematically, a firm's value is calculated by adding value of equity and value of debt. Value of equity can be calculated in the same way as it is calculated for an unlevered firm, that is, by dividing EBIT by KE, and the value of debt can be calculated by dividing interest payment by the cost of debt, that is KD. Thus, the value of the firm can be worked out by using the formula as shown here. Further, we can calculate the weighted average cost of capital WACC denoted by KO using the usual weighted average cost formula. KO is also termed as overall cost of capital. When we are given the net operating income or EBIT of a firm and its market value, then the overall cost of capital can also be calculated by dividing the net operating income by the value of the firm.
Let us now apply all that we have learned so far to understand the relationship amongst debt component, the value of the firm and overall cost of capital. We have taken three alternative financial plans employing different amounts of debt. EBIT is given and remains constant at 2 lakhs. Cost of equity is also given and remains constant at 10%. In the first financial plan, if we employ 6% debt of 5 lakhs, then the value of firm will be 22 lakhs as the sum of debt and equity and overall cost of capital will be 9% as shown here. Similarly, if we increase the 6% debt level to 7 lakhs, then value of equity goes down because of the increased interest obligations. Less amount is available for equity shareholders and value of firm goes up, and hence overall cost of capital also reduces by employing more debt. If we reduce the amount of debt to rupees 2 lakhs, then value of equity increases but firm's value decreases, and hence overall cost of capital also increases. Therefore, we can say that there is a direct relationship between value of debt and value of firm and negative relationship between value of debt and overall cost of capital.
Let us now apply all that we have learned so far to understand the relationship amongst the debt component, the value of the firm, and overall cost of capital. We have taken three alternative financial plans employing different amounts of debt. EBIT is given and remains constant at rupees 2 lakh. Cost of equity is also given and remains constant at 10%. In the first financial plan, if we employ 6% of debt of rupees 5 lakh, then the value of the firm will be rupees 22 lakh, as the sum of debt and equity and overall cost of capital will be 9% as shown here. Similarly, if we increase 6% debt level to rupees 7,
Capital structure is the debt equity mix in the total capital of a company. There are two schools of thought regarding the relationship between capital structure and market value of firm. One view is on relevance of capital structure, that is, capital structure affects the firm's value, that is net income approach or traditional approach. Trade-off theory, pecking order theory and signaling theory. The other school of thought states that capital structure is irrelevant if in determining value of firm, that is net operating income, hypothesis and Merton-Miller argument. Net income approach shows that there is a relationship between capital structure and value of firm, and therefore firm can affect its value by increasing or decreasing the debt proportion in the overall financing mix. Let us consider an example. The expected earnings before interest and tax, that is EBIT, of a firm is 2 lakhs. It has issued equity share capital and cost of capital is 10%. It has also issued 6% debt of 5 lakhs. Find out the value of company and overall cost of capital WACC. Let us solve this problem. Here we are given the EBIT of 2 lakhs. KE is 10%, KD is 6% and value of debt is equal to 5 lakhs. Let us solve the problem. EBIT is 2 lakhs less 6% interest on debt, that is 5 lakh, it is 30,000. Now net profit available to equity shareholders EBT will be equal to 1,70,000. That is 30,000 has been subtracted from 2 lakh. Cost of equity is KE is 10%. Value of equity is 1,70,000 divided by 0.10, that comes to 17 lakhs. Value of debt 5 lakhs. Total value of the firm comes out to be 17 lakh plus 5 lakh, that is 22 lakhs. Weighted average cost of capital WACC is equal to KO is equal to 2 lakh divided by 22 lakh, which comes out to be 0.09 or 9% approximately. WACC can also be calculated as follows. WACC is equal to cost of equity into weight of equity plus cost of debt into weight of debt, which is multiplied by E divided by V plus KD multiplied by D divided by V. By replacing the values or substituting the values in the formula, we get WACC as 9% or 0.09. Now if the company had issued 6% debt of 7 lakhs instead of 5 lakhs, the position would have been as follows. EBIT is 2 lakhs less 6% interest on 7 lakhs, that comes out to be 42,000. Now by subtracting this from EBIT, we get net profit available for equity shareholders, which is EBT, equal to 1,58,000. Cost of equity KE is 10%. Value of equity is 1,58,000 divided by 0.10, that comes out to be 15,80,000. Let us add value of debt to it, which is 7 lakhs. The total value of the firm now comes out to be 22,80,000. Weighted average cost of capital WACC will now be equal to 2 lakhs divided by 22,80,000, which comes out to be 0.087 or 8.7%. Therefore, if 6% debt is increased from 5 lakh to 7 lakh, the value of firm increases from 22 lakh to 22,80,000 and WACC decreases from 9% to 8.7%. Now suppose that the company has issued 6% debt of 2 lakhs only instead of 5 lakhs. The position would now be like this. EBIT is given, that is 2 lakhs. We will subtract the debenture interest or debt interest from it, that is 6% of 2 lakhs, which comes out to 12,000. Net profit now available to equity shareholders, which is referred to as EBT, that will now be equal to 1,88,000. Cost of capital KE is given, that is 10%. Value of equity is 1,88,000 divided by 0.10, that comes to 18,80,000. Let us add value of debt to it, that is 2 lakhs. Now total value of the firm is 20,80,000. Weighted average cost of capital WACC is equal to 2 lakhs divided by 20,80,000, which comes out to be 0.096 or 9.6%. Therefore, we can infer that the proposition of 6% debt is reduced to 2 lakh, the value of firm reduces to 20,80,000 and WACC increases from 9% to 9.6%.
Let us recapitulate what we have learned in this module. Capital structure is the debt equity mix in the total capital of the company. Both debt and equity capital differ in terms of cost and risk. We have learned about net income approach, which states that capital structure is relevant and affects the firm's value. As per net income approach, there is a direct relationship between value of debt and value of firm, and negative relationship between value of debt and overall cost of capital.